This is Series T, where we find the greatest entrepreneurs and investors in the world and force them to have tea with us, live on air. Today, we're doing a remote episode with serial entrepreneur and investor Elad Gil. In a past life, Elad started the mobile team at Google and co-founded Color Genomics. He also did a great book, which I recommend everyone read, called High Growth Handbook. Thanks for joining us, Elad.
Thanks for having tea with me.
You did a really interesting blog post recently that was kind of covering how startups are going to kind of deal with this kind of economic macro climate. How is this affecting startups right now?
Yeah, so I think we're definitely going to go into a longer and deeper recession than some people seem to expect. So I think that's going to be unfortunate. Fundamentally, the way I think about it is a 2x2 matrix, where on one side you have, are you being helped, hurt, or neutral by the coronavirus? So certain online collaboration tools are doing better and actually accelerating as shutdowns happen. And then in contrast, there are certain businesses that are just completely being decimated right now. Travel-related companies being an example. And then on the other axis is, will this shift sustain or not? It's quite possible that there's certain online learning companies that all the kindergartners are on right now, but 2 years from now, when everything's back to normal, they'll go back to like a much lower baseline.
If I'm looking at my budget for 2020 and I've got my plan in place, do you think it's worth just going like super pessimistic right now and saying, worst case scenario, let's prepare for that, let's cut costs, let's like go extreme? Or do you think like we wait for 3 months, see how it plays out before you do
it? Depends again if you're early or late. If you're 4 people, it doesn't matter. You have low burn already, assuming you have money in the bank, right? So say that you've just raised a seed round, I would just go business as usual. I would just quickly make sure that you can continue to close customers or that you can actually grow in this environment. If you're really early and you just raise money and you're building something, I would kind of make sure that what you're building is still relevant, but honestly, it's going to take you 9 months to a year to build a real first solid V1, most likely, which means it's not going to impact you very much. Like hopefully by then, things will have stabilized and be at a new basis set. So for early stage companies, I wouldn't overthink it. I definitely maybe wouldn't hire that random opportunistic hire for no reason, like you may have in a more capital rich environment. But for most early stage companies, it's going to be business as usual, unless you're in something like online travel where you're just not going to have a business for the next year. So you'll never be able to prove out metrics that allow you to keep going, in which case you may just want to consider doing something different.
Okay. What about late stage companies?
Yeah, so it depends on what you consider late. So even at 100 people, you'll probably have like a $20 million a year burn, which is significant. And so I would basically start asking the question of, how do we make our cash stretch? And making the cash stretch may mean raising prices on customers if you can, or getting paid in advance. It could mean having to hire, to freeze hiring, or it may mean having to do layoffs. It may mean having to redeploy your team against customers that you know are a good customer segment, and you cut the more speculative things that you were doing. So in general, it's really asking, how do I have sufficient cash to be able to bridge this and then have another year or so, or 6 months to a year to recover, so that if I need to raise more money and I'm not profitable, I can show a growth story to be able to do so.
You also mentioned like companies doing well through this. Like, at Mercury, we've seen quite a few extra signups because all the bank branches are closed. I think there's other companies like Tandem and obviously Zoom is the famous one that's like blowing up right now. But you said even that might not be like all positive, because this might be a temporary thing. Like, how do you think they should react? Like, I mean, should they scale up and like go like really after this opportunity, or
Sure. It depends a lot on the company. I think if you're seeing strong growth and you can scale it in an ROI positive manner, $1 put in yields $2 6 months from now, it's totally worth continuing to scale it. The main thing I would keep track of is what is marketing and sales expense that you can gear back if you need to, and what is headcount expense. And so the mistake people make is sometimes they just start ramping headcount because they think a big business is there. And then if the business suddenly goes away because of a shift in behavior back, that's when companies get hurt, because they have a broader sort of built-in burn rate. And so really it kind of depends on where the expenses come from.
From raising money, like growth is everything. So like if they have this huge kind of spike up and then it, in 6 months from now, like massively falls off. Like
it depends on where the baseline gets reset to, because if you end up getting reset to a 2x from where you are today, that's great. In other words, it may have saved you a year of struggling for customers and growth because customers are now looking for you, or maybe it saves you 2 years, right? Like Zoom has probably been accelerated by 2 or 3 years in terms of enterprise adoption. And so even if usage drops because not everybody's just only doing video conference calling, and people actually start meeting in person again, it's probably going to start at a higher baseline because more companies will have adopted it. So it's going to be very net positive for Zoom, even if usage drops as people shift behaviors back.
And let's say I'm a company that, thinks I've got something and we need to like wait this out for 6 months because revenue is dropping or whatever. Like what are the steps like they should be taking right now?
Yeah, I mean, number one is they should be looking at both revenue and cost. It's going to sound really obvious, but how do you increase revenue? How do you have customers prepay? How do you make sure they have cash coming in the door? And then on the cost side, what is a real cost structure that I need and how should I sustain it? And if you need to do a layoff, the big mistake people make is they don't cut deep enough or they wait a long time and you just end up with dramatically less runway. Because if you wait another 6 months with full burn, that may really shorten your runway once you actually do a layoff. So you've both done a layoff at that point and you don't have enough money to keep going. So if you do decide to do a layoff, I would do it early and I would do it much deeper than anybody expects. I actually moved out here as the internet bubble was collapsing in 2001, and so I had perfectly bad market timing in terms of coming out here. And I joined a company at 120 people. It grew to 150, and then it shrank to 15 people over 5 rounds of layoffs. And every subsequent round, they just didn't cut deep enough. And so the company just kept being a few steps behind on burn and team size. And the morale kept getting worse and worse and worse because you keep cutting and cutting and cutting and nobody ever knows where it's going to end. And what they should have done is just done a really steep cut all up front and just been done with it. And then the company would have had runway for many years because it had raised, $80, $90 million at the time. And most of it was—
what is a runway they should be aiming for? Like if you're like, let's say hypothetically you got 50 people, you think you have a 1-year runway. Now this has happened. You're worried that your revenue won't grow. You won't be able to raise in 6 months.
I would try and end up with at least 2 to 3 years of cash, because the reality is, it may take a year or more for this to sort of bottom and then start to come back. And then you need to show a quarter or two of growth before you can raise more money again.
Yeah.
And then you need at least 6 months to raise. So that puts you at a minimum of 2 years. If you can get 3 years, that's better. But again, that may or may not be realistic. And at some point you hinder your ability to keep going. The other option is you can consider exiting, and that could be either for a company that is working or is not working. If it's not working, you may want to exit while people are still buying, although a lot of bigger companies are starting to freeze up more and more. So the best time to exit may actually be in about 6 months when the bigger companies have done their layoffs or their hiring freezes and sorted things out and then decided what's strategic for them going forward. And if you're doing very well, but you don't think that what you're doing is sustainable after things snap back, now may actually be a time to exit if things are growing really, really well, but you don't think it's going to last. So there may also be scenarios where you're like, oh my gosh, everybody's now adopting me because nobody can leave the house. And in a year and a half, I just don't think this is going to keep going. So let me find a buyer.
I mean, that's always a hard decision. Like, how do you know if it's like not going to keep going? Like, what's the thing you would like look for? Like, how do you know this is not a more permanent kind of change in people's behaviors?
Yeah, I guess I would just ask, like, are people spending time on what you're offering simply because they don't have any other choice, but they have such a strong preference for the offline version that your new baseline reset, even if it's 3x where it is, isn't the 30x that you're seeing. And so I do think that's happening with some types of online education. Not all. I think there's online education apps that will really thrive through this and then stick and do really well. But, I have 2 young kids at home, and we're trying different learning platforms, and those are exploding right now. And we're trying them a lot, daily to keep our kids occupied. But you know what? Once they're back in school, we're not going to be using these things every day. Usage is going to drop pretty dramatically, in my opinion, for some of them. And so I would just try and be self-honest around what is forced behavior versus a real systemic shift. And related to that, I think the biggest version of that is working from home. So, as a parent of young kids, my productivity is taking a real hit. People without kids are all telling me how incredibly productive they are, and this is like a golden age outside of worry and death. It's a bad period, but from a productivity perspective, a lot of people are being extremely productive at home, and part of that is because they have nothing else to do. They can't go out. They're quarantined. Yeah. And so I think the takeaway a lot of people will have is that working from home works great, and everybody should be a distributed team and all these things. But my experience is that about 10% of people are extremely effective working remotely. 90% are really bad at it. But today they're really good at it because they have nothing else they can do.
That's a pretty contrarian take. Do you think 90% of people can't work from home? Like why
Not effectively, yeah.
like why? They're not motivated, they don't have the tools, that it's hard to
Uh,
do a job remote.
it's a mix of motivation tools, and I think there are certain roles where you have to interact with people frequently in person in order to get certain things done.
And you don't think like video, like Zoom interactions, like good enough right
I
now?
think it helps, but I don't think it's the panacea. I think there's a reason people were still getting on flights and doing sales calls, and maybe they'll do fewer of those after this, but I don't think it's going to be zero. I think it's 20% fewer, and we'll see. I mean, maybe this is the fundamental shift, and
Yeah.
we're never going back. I just think that's unlikely.
There's this question that's come up quite a few times. So, there's companies that were just about to get into a seed round, or maybe that slightly kicked off a process. And there's other companies that were thinking about Series A.
Yeah,
They were, close to the end. So it's not like easy for them to go extended 2 years or something like
yeah.
that. Yeah. What do they do?
I've been seeing a number of things close. In general, it's companies that were either in process and they just made it over the finish line, or it's companies that are accelerating through this period. So one question to ask yourself as a company is, how can this accelerate my business? Is there something I should be doing differently? Are there customers I should be talking to that I didn't before? Can I build some form of collaboration into my tool that will help make it more valuable to people now that they're working from home? Can I build something that helps increase the productivity of people who are now remote? So I do think for certain companies it's accelerating. And I know one company, for example, that just got a term sheet this week from a top tier firm because they're in the right market segment. And so people are excited about it. I know of another company closing a late stage round. So, the financing events are still happening. That said, a lot of VCs are sitting kind of on their money because they think that things are going to get worse over the next 6 months. And it's really hard to predict what are these companies going to look like 6 months from now in terms of the companies where sales and success are uncertain, right? For the things where it's certain it's working, they're going to raise money, no problem. For the things that are clearly blown up by this, they need to cut cash or somehow survive or be willing to take money on bad terms just to make it through for when things come back.
Yeah. You think companies should like reopen their previous round and try to do something there, or you think
Yeah,
they should?
yeah. If it makes sense for them to do so, absolutely. And the one thing I should say is, in general, when these market downturns happen, things always feel very cheap to the founders, and they always worry, oh, it's like a 20% discount from where I thought I would be. And then the next month it's like, oh, it's a 40% discount. And the next month it's, oh, it's a 60%. And so my suggestion would be get it done fast if you're going to do something, and don't over optimize, and take a deal that you think is bad now. Because in 60 days, it's going to look like a great deal because the market's sliding. And if you set your price and the market slides faster than you can close the thing, you're going to be stuck. Like you won't be able to raise money.
Going back to something we talked about previously, if you're looking at like potentially a down round, one thing that's like always strange is like fundraising is all about the future, and you're selling this promise and all this stuff. And that's why like in normal markets, like down rounds are like, oh, like, something must have failed for you to be like coming out again at 10 million when you did a 12 million seed round or whatever is this thing. How do you sell that as an entrepreneur? How do you sell it so it doesn't sound like you failed?
I mean, the reality is Facebook did a giant down round.
Oh, did they?
So yeah. So everybody forgets all the history on this stuff. In 2008, I think it was, Facebook raised it like a $15 billion valuation from Microsoft.
Yeah.
And then they actually had to raise it somewhere between 8 and 10. And that's when Yuri Milner came in and did the combination of secondary and primary and all this stuff. And so Facebook, one of the most important companies in the world, did a down round, right? And so it's perfectly fine to do one. If your valuation got way ahead of your business and you were sort of betting on always being able to raise more money, you may be in a situation where you're now burning through a lot of cash, and potentially rightfully so, right? If it's helping build a business and the business is still working, it's just going to be harder to raise money. And if valuations and multiples have come down, you may need to just be willing to accept the fact that valuations are lower now. And even if you have a great future ahead of yourself, you need the capital. And the capital will help accelerate your business. It'll make it stable. And if you raise enough money to never have to raise again, you're in great shape. And so I think it's perfectly fine to do a down round.
Now, how do you like position it to the investors so it doesn't sound like, like investors always want to do hot things, right? Like they want
Yeah. It depends on your business, and it depends on how well you're doing. Like, say you went from 20 to 50 million in ARR, and it looks like you're going to do, your original plan for the next year was 100 and you're going to do 70. At least that's what you think you'll do. You just go and say, look, here's how we've been impacted. This is how our projections have shifted. Based on this plus the environment, we just want to get something done quickly. Here's how much we want to raise. Let's talk through valuation. I think it should just be a very rational conversation. And I know a number of people in the venture community who are actually looking for opportunities like that, because they're fundamentally great businesses that are going to need capital, that may be able to create a situation where they can make it to break even off of this money or off of a small incremental additional money beyond what they're raising. And if that's the case, those people are going to be able to raise money. And the real question is at what price? Mm-hmm. And as mentioned, price is going to continue to slide until we hit some bottom on this. And so it's better to just take the pain and raise it a lower valuation than you think now, than to wait another 6 months and then maybe you raise it another 30% discount because all the prices have come down. And that's part of the calculus. You could also say, well, I'm going to wait it out. Or if you have enough money and you can go raise next year, maybe you wait till next year, right? It just depends on how much risk you want to take, how much certainty you have in terms of how the year is going to look, how essential are you really to your customers. So all those things play into it.
So what about all these seed funds and VC funds that, just like in 2019, everyone's been announcing like, I have $100 million, I have $1 billion. Like, surely they still have that money. Like, don't they need to deploy it?
There's absolutely a lot of money on the sidelines, and there's a bunch of people who've just closed funds. The flip of it is the venture community was burning through capital at a faster pace than they used to. And so the fund cycles used to be every 3 years or so. And more recently, VCs have been raising every 18 months. And so if you raised $1 billion fund 12 months ago, you're probably 2/3 through it. And so all these folks are going to have to go back out for capital raises in a less certain environment. And so I do think that at some point, some of these funds are going to start shrinking fund sizes because they won't be able to close the money. And again, that's probably 6 to 12 months away, assuming that this is an ongoing economic issue.
I've seen a few companies go after, a lot of them are doing just to help the US, obviously. Some of them are also seeing it as like a potential, pivot away from like something that wasn't working. Like maybe they were travel companies, but now they're like going to do a contact tracing app or something like that. You think that's like a good maneuver?
I would largely view it through the lens of, is this going to be additive to my business long-term? Or is this something I want to be in long-term? Because the reality is, one way or the other, in 18 to 24 months, we're going to be largely through with this. And so if you think about it as an, 12 to 24 month thing where you're building something to participate in what's happening, if it's purely philanthropic, great. Then you don't have to justify it. If you're really trying to build a business around it, you need to ask yourself, okay, it's 18 months from now and things are dying down in terms of number of cases and everything else for the final wave, hopefully. Do I have something sustainable here as a business or not? And if not, it's not necessarily worth doing unless your primary focus is the philanthropic side, which is a great focus given everything that's happening.
Is this a good time to start something? And if you were going to start something, like, do you think you should like work on spaces that are like directly related to opportunities that like are rising right now?
Sure. Yeah, I think fundamentally now is a good time to start a company because there is going to be a lot of talent available in the market. So there's either people who are laid off or companies that they're not super excited to be at anymore. And so there's going to be a lot more talent in the system in a few months. So you'll be able to hire and build teams. There's still a ton of seed capital around. So you may not get the same valuation, but you'll still do perfectly fine. Like I remember I didn't invest in Airbnb seed, but I think their seed round was at like a 2 or 2.5 million valuation. And when I raised for my first company, we raised 1.5 on 6, and everybody thought that was an insane seed round. They're like, oh my gosh, that's like a Series A, Yeah. And so, valuation expectations since then have obviously expanded pretty dramatically. And so you may not end up with the same valuation, but there's tons of money out there. There's going to be a lot more people that you can hire. And so I think there's enormous amounts of opportunity. And, early stage companies just don't consume that much cash, And then in terms of what to build, I think there's 3 ways to think about it. The first one is to ask, what are near-term opportunities to your point? So are there remote working tools or, you could think of it from a verticalized perspective. If finance teams can't meet in person anymore, what tool do they need to be able to capture behavior online or whatever team or vertical you want to choose, right? So I do think there's also really interesting vertical SaaS opportunities. There's remote work opportunities. There's industry-specific opportunities in terms of, every industry is now working remote for the first time. what are specific things that they need to do. Maybe it's inventory or supply chain management. Maybe it's something else. So I just think there's tons and tons of stuff to build. There may be consumer related productivity tools. So you could do that. And then the last thing you could do is you could think ahead and say, okay, look, it's going to take me 6 to 9 months or 12 months, or it depends on what you build. It's going to take me some time to build something. So what should I be building that is just an app I've always wanted or a tool I've always wanted? And I'm just going to start building that. The one other thing to consider too is now may be a great time to build social products because there's a lot of people at home with no other outlet staying at home. And so you may actually be able to get very fast social adoption of products in a way that you couldn't before. And so there may be really interesting things to do on the consumer side.
This has been awesome, Elad. Tell us a little bit about investing.
Oh, sure. As an investor, I've invested in, I think it's now 23 companies worth $1 billion or more, wow. 16 of them at the seed or Series A. So that's companies like Airbnb, Airtable, Coinbase, Gusto, Instacart, Stripe, Square, Pinterest, Notion, Wish, etc.
I think you have like the most ridiculous track record. Like, what's the magic trick here?
I think I've been super lucky in terms of the sets of companies that I've been able to get involved with. And then I think part of it is just being a very market-driven versus founder-driven investor. So most early-stage investors say that they only focus on who the founder is. I think the founders are obviously, crucial, but I also think the market and the product market's very important because I've seen incredible founders get absolutely crushed by bad markets, and I've seen absolutely terrible founders do extremely well just because the market's so good.
I think maybe 1 or 2 would be luck, but 23 is skill. When you say market, like, is it just like size of market, or like maybe it's a small market but it's growing really fast, or is it like?
Yeah, I kind of view it as product market. Like, are there signs that the market really wants the product? And so an example would be, PagerDuty really early on was 4 folks out of Waterloo. Nobody had ever heard of them. And big companies were just showing up and buying their product, right? Like, I think, can't remember if it was Apple was an early customer, NBC was an early customer. Like, that these really big customers showing up and just buying what is a crucial piece of engineering infrastructure. And so it was clear that the market wanted their product. They were growing, I don't remember what it was, 20% month over month or something off of a small base, but it was just kind of obvious that the market wanted it, So sometimes you see things like that and you're like, wow, there's clearly an opportunity here. It was unclear what the TAM was, or the total addressable market, but to some extent, the growth rate of a company is reflective of its effective TAM. In other words, the faster a company is growing, particularly the bigger the revenue basis, the bigger the actual TAM is, irrespective of the calculation you do on the real TAM.
Okay, I see. So is there a reason you're avoiding calling it like product market fit, or?
Yeah, I think product market fit's a great term. But the problem is it's hard to know if it's true product market fit.
Yeah.
If it's very, very early, or if it's just slides, right? Like when I invested in Gusto, it was just the team and the idea, and there wasn't really a live product yet. So you didn't have the market data to know that there's product market fit. But you knew that ADP was bad and Paychex was bad, and you know that there was an opportunity there.
All right, Elad, this is awesome. Thank you for joining us. If people want to find you online, where's a good place to find you?
They could just look me up on Twitter. I'm at Elad Gil.
Yeah. And you have a great blog, actually. Infrequent, but every blog post is amazing.
Oh, thanks so much.
All right. Thanks for coming and joining us.